Known as the Oracle of Omaha, Warren Buffett is a philanthropist and businessman, but he's probably well known for being one of the world's most successful investors. His investing career began when he was just 11 years old and he filed taxes for the first time at age 13. He is the head of Berkshire Hathaway, an investment company that owns 60 companies such as Geico, Dairy Queen, and Duracell. With all of this, he was placed at number 6 in Forbes Billionaires 2021 and has a net worth of $114 billion as of this January. In his 80 years of investing experience, he's made a lot of mistakes, and he's also seen a lot of mistakes that average investors make. Hello and welcome to our channel, folks. In this video, let's learn and look at the 10 mistakes every investor makes according to Warren Buffett. Mistake number 1. Investing nothing at all. The worst investment I ever made, the biggest mistakes, are the ones that actually don't show up. They're the mistakes of omission rather than commission, as said by Warren Buffett. One of the biggest mistakes you could make on your investing journey is not investing at all. The simplest reason for investing our money is to achieve our life goals. Investments are made with the primary objective of building wealth and corpus for the investors, whether they are short-term, medium-term, or long-term. Money is needed for every goal, regardless of its nature. Investing prudently is the only way you can make your money work for you. In addition, if you avoid investing, you will miss out on the compounding benefit. You will miss out on the opportunity to grow your money and enhance your wealth. The risks associated with not investing outweigh those associated with investing. Consequently, you must invest your money in well-regulated financial instruments based on your goals and risk appetite. Be sure to monitor your investments regularly and adjust them as necessary. Mistake number 2. Trying to time the market. Trying to time the market is extremely difficult. In fact, even institutional investors often fail to do it successfully. Buffett stated that it is the greatest mistake that investors make. In 1986, Brinson, Hood, and Biebauer published a study, Determinants of Portfolio Performance, Financial Analyst Journal, analyzing American pension fund returns. According to this study, investment policy decisions explain nearly 94% of return variations over time. It means that the majority of a portfolio's return can be explained by asset allocation decisions rather than timing or even security selection. The stock market is the result of companies' earnings and forecasts, investor psychology, and the ability of institutional houses to move markets in a certain direction with enormous positions. Therefore, it cannot be predicted with any degree of accuracy. Trying to time the market is a losing proposition, and for long-term investors, it should not be relevant. Regular investing in a well-diversified portfolio should be your focus as an investor. Regular investment allows you to profit from fluctuations in the market by purchasing more shares when it dips down and being part of the winning crowd when it reverses. And this is called dollar cost averaging. Timing the market does not play a part in creating wealth. Investing in the stock market is the only thing worth timing, since history has shown that it will only move up. Mistake number 3. Losing control of your emotions. The stock market is partially driven by emotion, and this is perhaps the number one killer of investment returns. Investors believe the market is driven entirely by investor psychology in the short term. As soon as they hear about an upcoming earnings report, people race to buy before the rest of the market. Buying assets shouldn't be a reaction to your emotions, even though psychology is the primary driving force for individual investors. Because of this, investors need to develop a strategy that includes specific rules they can stick to. In spite of this, the media likes to drive emotion. Several television stations keep up with market movements, rumors, and other current events. The coverage of these events enables advertisers to increase revenue. It should be noted, though, that financial pundits are not always professional investors. Additionally, you will never receive straight answers. A variety of experts will be interviewed by the media about current economic conditions and how to play the stock market, each contradicting the previous expert's comments. Due to this, viewers tend to overthink their decisions and worry about the worst-case scenario. They frantically check their portfolios to see how their positions are faring. Markets and the future are unpredictable, so all the media can do is create a sense of panic or excitement that drives short-term movements. Contrary to popular belief, short-term market movements have very little impact on long-term investing. What matters the most is that the stock market gains value over time. It is important that investors do not let greed or fear control their decisions. Investors should focus instead on the big picture. Historically, large-cap stock returns can average 10% over the long run, despite wildly divergent short-term returns. Portfolio returns should not stray too far from these averages when viewed over a long period of time. It may actually be beneficial for patient investors to take advantage of other investors' irrational decisions. Mistake number 4. Buying stocks without the intention of holding them forever. For how long should a high-quality business be held after it has been acquired at a reasonable price? Clearly, Warren Buffett believes in buy and hold investing. Some of his positions have been held for decades. But why? Among other things, excellent companies that maintain bright long-term prospects are hard to find, which is why Buffett focuses on a limited number of companies. Additionally, quality companies create high returns and growth over time. In the words of Warren Buffett, time is a friend of great companies. Stocks prices are impacted by fundamentals over years, and only patient investors can reap the benefits. Investment returns are harmed by excessive trading activity. Taxes and trading commissions are a major drain on returns when you are continually buying and selling stocks. So buying right and holding on is generally a good strategy. Mistake number 5. Diversification can pose a threat. Mutual funds typically own hundreds of stocks in their portfolios. However, Warren Buffett is the complete opposite. According to Buffett, the market rarely provides a great deal on great companies at a reasonable price, and he invests with conviction behind his best ideas. The opposite end of the spectrum is when investors overcompensate for fear and/or ignorance by diversifying their portfolios excessively. In addition, too much diversification can erode the value of a portfolio's high-quality holdings by investing in many mediocre businesses. Managing investment portfolios requires diversification, but it must be done correctly. Mistake number 6. Not considering low-cost index funds. Are you aware that most investors fail to beat the market and they fail by a huge margin? Taking excessive risks, trading on emotions, venturing outside our circle of competence, and many other things can harm your performance. Unfortunately, many actively managed investment funds charge excessive management fees that eat away at returns and dividends. Despite being the most prolific stock picker of all time, Warren Buffett argues in his 2013 shareholder letter in favor of passive index funds. After Buffett's death, his trustee had clear instructions on what to do with Buffett's Berkshire Hathaway shares. My advice to the trustee couldn't be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I suggest Vanguard's. I believe the trust's long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers, Warren Buffett said. Most stock pickers fail to generate results that justify their higher fees, so many investors may consider low-cost passive indexing if they are not concerned with generating stable dividend income. Mistake number 7. Excessive cash holding. It's understandable why people might choose to keep larger sums in cash during volatile markets. It can seem more tangible than other assets since we handle it every day, whether physically or digitally. Cash, however, loses value over time, especially in the current low-interest climate. Following the 2008 financial crisis, interest rates have been historically low for well over a decade. It is not uncommon for central banks to set interest rates that are close to zero or even negative. Having a low interest rate environment is good news for borrowers, but it is not beneficial for savers. You probably won't be able to earn the same return on your savings as you used to, especially since current rates are well below those before 2008. When you hold too much of your wealth in cash, you will not be able to keep up with inflation, which will lower your purchasing power and make it harder for you to reach your goals. Mistake number 8. Never compromise on business quality. It is fairly straightforward to say no to complex businesses and industries, but identifying high-quality businesses is much more difficult. In the past 50 years, Warren Buffett has developed an investment philosophy based almost exclusively on investing in high-quality companies with potential for long-term growth. There may be some investors who are surprised to discover Berkshire Hathaway's name originates from Buffett's worst investment. Buffett bought Berkshire because the price of the business looked cheap compared to similar businesses in the textile manufacturing industry. Even if the long-term performance of the business doesn't improve, he believed that if you buy a stock at a sufficiently low price, some unexpected good news is likely to come out that gives you an opportunity to unload the position at a decent profit. Warren Buffett has changed his stance on quote-unquote cigar butt investing as he gained more experience. According to him, buying businesses in this way is foolish unless you are a liquidator. It may turn out that the original quote-unquote bargain price wasn't such a good deal after all. One problem is almost never solved before another one surfaces in a difficult business. The return on capital earned by these companies is usually low, further depreciating the value of the original investment. And according to him, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So you should not give in to the temptation of good prices, but rather make sure you are comfortable with the company's quality. Mistake number 9. Not investing in yourself. The key to growing your wealth is investing your money wisely and consistently. Despite our differences and preferences in investing, this one thing we all have in common is something everyone should invest in first: ourselves. Buffett said in an interview with Yahoo Finance editor-in-chief Andy Serwer that, quote, "By far the best investment you can make is in yourself. When you invest in yourself, you start to acquire knowledge and other skills that influence the ROI on anything you do. Getting the right education helps you diversify your knowledge, improve decision-making, help you make better financial decisions, maximize your career and business options, and much more." Mistake number 10. Investing in what you don't know. The mistake may be obvious already, but some people still make it. Your financial assets are at risk when you invest in something you do not understand. Many investors are attracted to the latest hot investment. Although they may not know much about technology, biotech, or the particular business the underlying company is engaged in, they are convinced it will be a profitable investment. Studying a company or industry that is too complex to understand is a waste of time. It is for this reason that Warren Buffett has historically avoided investing in the technology sector and has also stated, quote, "Never invest in a business you cannot understand." In conclusion, investing involves mistakes. Nevertheless, knowing when you're making them, how to avoid them, and when not to make them will help you succeed as an investor. Remember to create a thoughtful, systematic plan and stick to it so as not to commit the mistakes discussed in this video. Learn from other investors' mistakes and do your research. So that is all the time we have today, folks. I hope you enjoy this video. If you have questions, please do feel free to ask them in the comments below, and don't forget to show your support by liking this video and subscribing to our channel to view more of our amazing videos. Oh, and one more thing, please do hit that bell icon on your way out to remain updated about all of our future videos. We'll see you next time.